Well, good afternoon. Happy Friday, December 20th. Mark Milam here. Let's get right to it. Really an interesting week, kind of a fascinating week with what happened in the United States economically. We saw what happened in the stock market, and if you pay attention to the bond market, you saw similar volatility, but none of this really coming off of data per se, and it's really coming off of our Federal Reserve, both their words and their actions. So let me flip the screen around here. Let's talk about it for a quick second. These are mortgage-backed securities. As a reminder, red days are bad days, green days are good days. This was Wednesday, the day that the Federal Reserve cut the Fed funds rate by 1/4 of a point, and it was really where all the damage was done this past week. So we had a big sell-off in mortgage-backed securities. The 10-year Treasury shot up a good bit. The Dow Jones lost, I think, over 1,100 points on the day. Just not a good day for the markets in general. Why did this happen? First of all, it's not because the Fed cut the Fed funds rate by 1/4 of a point. Everyone expected that. Futures traders have been pricing in a 90% plus chance that the Fed was going to cut the Fed funds rate by 1/4 of a point for the past several weeks. That was no surprise. Where we got the surprise was in the dot plot projections and then the Fed's comments at 2:30 during their press conference. Let's start with the dot plots. So the Fed meets 8 times per year, and 4 of those meetings include dot plot projections of voting members on where they think the Fed funds rate will be out into the future. And let's take a look at some of these. This is kind of fascinating. So I'm going to take you back to June. Let's go back 6 months to June 12th at the Fed meeting there, and this is the dot plot projection. And you can see, as we scroll down the page here, this year over here on the left is 2024, this is 2025, this is 2026, which is absurd to think that anyone can predict where the Fed funds rate is going to be in 2026. But let's start here in 2024. So they're predicting an end-of-year rate somewhere between 4 3/4 to maybe 5 1/4, okay? By the way, we're at 4 1/2 right now, so this wasn't that far off. And then they were predicting an end of 2025 Fed funds rate somewhere around 4 to 4 1/4, somewhere in that neighborhood, and then off we go into 2026. But take a look at what happened in September. September really changed things for the Fed. And remember, the Fed started cutting the Fed funds rate on September 18th. We got our projections that the Fed funds rate is going to finish out the year around 4 1/4 to 4 1/2. Look at the end of 2025. Remember, this is 2025. All the Fed members clustered down here at the bottom, close to 3 to 3 1/4, maybe 3.5% on the Fed funds rate, a significant decline from just 90 days earlier in June, and then off we go here into 2026, 2027. Here is this past week's dot plot projection, the December 18th dot plot projection. And you can see that in 2025, we've moved back off of this 3, 3 1/4, 3 1/2 range, and all the voting Fed members are clustered back up here close to 4% on the Fed funds rate. All that to say, what the Federal Reserve basically did is they took a couple of rate cuts off the table for 2025. They basically said, hey, for whatever their logic is, we don't see the need to cut as much next year as we thought we did 90 days ago. 90 days ago. So that startled the markets. The markets are now pricing in half as many cuts for 2025 as they thought they would, and that's one of the reasons why we saw the stock market and the bond market perform so poorly on Wednesday. That's frustrating because it's just a 90-day window. What's even more frustrating is what the Federal Reserve Chairman did next, which is at 2:30 Eastern Time. The Fed has its normal press conference that comes after the policy statement, and the Fed let it slip at that press conference that they believe that the Fed's target of 2% inflation is not going to happen until 2027. The Fed has a dual mandate. The Fed's dual mandate is to promote maximum employment, which is usually somewhere around 4%. 3.5% to 4% unemployment is basically full employment. The second part of the dual mandate is to promote price stability. Price stability is loosely defined as 2% inflation. Now that 2% inflation year over year, it's an arbitrary number. They kind of just made it up, but it is what they view as the stable rate of price growth, right? 2% inflation. And our Federal Reserve, which just embarked on the fastest rate hike spree in modern history over the past couple of years to do what? Get inflation under control, is now telling us at the end of 2024 that they don't anticipate we're going to get to the target rate of inflation until 2027, 2+ years from now. Those comments were not well received by the market. And what made those comments even more puzzling is that the Fed cut the Fed funds rate on Wednesday. Listen, cutting the Fed funds rate is stimulative, right? That's not going to help get inflation under control. So you're kicking the can on inflation out 2+ years to get to your mandated 2% rate, yet you're simultaneously cutting the Fed funds rate on the same day. That's not an understandable set of circumstances. And if you listen to Powell's press conference, you can kind of hear the uncertainty or maybe the lack of direction in some of his comments. Let me flip the screen back around and tell you, based upon my research, something that I agree with. So this is Jim Bianco of Bianco Research. And what he thinks happened here, this is the rate of unemployment. And if you go back here and you start looking at 2024, at the rate of unemployment was ticking up. Now, it doesn't sound a lot to go from 3.8 to 3.9 to 4.0 to 4.13. But in July and August, we were starting to get up to 4.13 to 4.20. These rates of unemployment were starting to go up. And we actually triggered something called the Sahm rule after Claudia Sahm. And the Sahm rule has been somewhat of a reliable predictor of recession. And there's widely thought here that perhaps the Fed panicked. And the Fed cut the Fed funds rate by 0.5 point here in September, on September 18th. And since then, long-term treasuries like the 10-year treasury have not been performing well. The yields have been skyrocketing. This is the cumulative change in 10-year treasury since the Fed began cutting at every Fed rate cut cycle since the late 1980s. We are the dark black line here above. So you can see we are increasing or rising in yield on a trajectory higher and faster than any other cycle that we've seen since the late 1980s. Mortgage rates are very, very closely aligned with the 10-year treasury, and that's why mortgage rates as they sit today on December 20th, 2024 are 0.5 point higher than they were on December 20th of 2023. Listen, we think the probability of a Fed policy mistake is still in play. Perhaps they made one back in September when they cut by 0.5 point, but to cut the Fed funds rate on December the 18th and simultaneously say that we're not going to get to the Fed's mandate of 2% inflation until 2027, those two things don't go together. Those two things do not make sense to happen simultaneously, and they certainly don't make sense to happen on the same day within a 30-minute window of one another, and that's why we saw the bond market perform like it performed. My personal take is this is a vote of no confidence from the bond market to our Federal Reserve. Will be very interesting to see how this plays out as we move into 2025. Until then, I hope you have a very Merry Christmas and Happy Holidays to you.